So today we are going to talk about nothing else but technical analysis. What is technical analysis? Functions, assumptions, principles, pros and cons. These are very important because if you don't know how technical analysis works, how it functions, the principles of it, you won't be able to apply it. Dow Theory, types of trend, stages, types of gaps, tools and indicators. I know you want to skip to this place. If that's what you want to do, go back to your job. So I need two things from you as usual. I need your pen and pencil and paper and your attention. Okay, so what are the functions of technical analysis? It allows you to become fortune teller. It allows you to analyze present, past, price action. And what a lot of people don't appreciate about TA is that it allows you to backtest and look at various different things like volatility, historical highs and lows. How often does this market gap? How often does this market trend? And when it does trend, how long does it last? How long does the bull trends normally last? How long does the bear trends last? Are the bull trends longer than the bear trends, or are the bear markets longer than the bull market? How often does this currency pair or market range? When the interest rate differential between two currencies is very small, the currency is going to range more as compared to a currency pair in which the interest rate differential is very large. When there's an economic announcement, political speeches, situation going on, gotta inject some disinfectant. How does it react to all of these things? Or does it not react much? TA also helps you determine entry, TP, stop loss, volume, sentiment, momentum of the trend, very important, and also the trend stages. I'm going to get to this later on. And also the market conditions. Is it trending right now in a very quiet manner, or is it trending right now in a volatile manner? There's a difference, okay? Is it ranging right now in a very calm, quiet manner, just like me? Or is it ranging right now in a very volatile, chaotic manner? If you are a fundamental analysis, do you think that you can backtest all of these things? You need to do a lot of number crunching. It is not that visual as compared to looking at the charts. Karen, I know what is TA, don't need to tell me. It is strategy, indicator and trading system. But can you give me a proper definition? You are studying market sentiment. Of course, if you are using only MACD, you'll be like, what sentiment? What you're really studying is human psychology. This is really important. If you don't understand human psychology, you don't understand humans, you understand your dog more than you yourself. You gotta look at the mirror. And what are the tools that you look at to study market sentiment? You look at price action. Because price action can tell you a lot of things about what traders are feeling right now. And if you're a stocks investor or trader, you will look at volume a lot. If you're a futures options trader, you will look at open interest. And all this just to take advantage of one thing, which is market inefficiencies. Give me an example of what is inefficient. I say I want to write a book 3 years ago. Until now, I still haven't complete. In a lot of finance textbooks, you will come across this term called market efficiency theory. In short, it's called EMH. So what's this theory all about? It says that in the markets, all of the information or expectations of what is going to happen, all of these things are already priced into the market, and hence traders, investors cannot make money. If this is true, then why are there market crashes? Why are there so many hedge funds, billionaires who earn more than celebrities? Why? Why is this so unfair? Actually, it's pretty fair. Textbook knowledge normally does not work in the real world as you know it. Yes, information do price in, but it doesn't price in as fast as what the textbook says. When you're a trader, you want history to repeat itself. If you do horse betting, you want history to repeat itself. If you want to vote for Donald Trump, you want history to, wait, what? One of the assumptions is this. Of course, when we make assumptions, somebody's gonna come and challenge you. So somebody came up with this theory that says, no, history will not repeat itself because, you know what? Markets are random walk theory. So if you study finance textbooks, this theory says that markets move in a random manner. Is it really true? If that's true, then all the things that we talk about on this channel is completely useless. The trend lines, moving averages, Fibonacci, CCI, RSI, stochastics, everything that I teach you, completely useless. It's just for entertainment. It says that past cannot influence present, present cannot influence future. And if this theory applies, we are also assuming that as humans, we trade, invest in a random manner, like we buy and sell randomly. Even though economic conditions change in the past 100 years, but then human behavior still remains the same. Human biases still remain the same because markets are driven by expectations of investors and traders, which doesn't change in the long term. That is why it will repeat itself. That is why this theory does not apply in the real world. It only applies when you take your finance exam. The other two assumptions, this one already talked about just now. Market moves in trends. That is why trend following strategies are really popular, and popular trend trading indicators. A lot of people will use moving averages as well as trend lines, and of course add that with price action. And to be able to trade trends in the long term, which lasts from weeks to months, you need to master one very important thing, and also one annoying thing for a lot of retail traders, and that is fundamental analysis. So you combine FA with TA to help you spot entry points, FA to tell you what the market's direction is going to be in the long term. Couple of principles you need to understand, the most important one. Let's say this pie represents your profitability as a trader, your success level as a trader. How much does technical analysis contribute to your success? 10%. And yet, most retail traders, they put 99.99% of their attention on technical analysis. And they wonder why. Karen, am I still losing money? Did you study risk management? What is that? 30% risk management, 70% psychology. And you think that studying human psychology is not important at all? So indicators only contribute to 10% of your success as a trader. Remember that. Remember that. Another principle is that when you pick an indicator to trade with, you gotta apply it to the right kind of context. Context. What does context represent? Apply it to the right currency, to the right kind of markets. Alright? Because some indicators, they work better in certain markets. Of course, things like candlestick trading, price action, the good thing is that you can apply to all types of markets and also apply it to the right kind of market conditions. What does market condition represent? Is the market trending? Is it a very volatile kind of trend? Or is it a very calm and non-volatile trend? Is the market ranging? And also, is it a volatile range or a very calm range? Or the market is just chaotic in general? It's just volatile. You cannot tell whether it's ranging. You cannot tell whether it is trending. Certain indicators work better in a trending market. Certain indicators work better in a ranging market. Next three principles. Use an indicator in which you are comfortable using. But Karen, Tony Robbins told me to get out of my comfort zone. Okay, Ken? Yeah, can. Don't try to find a magic indicator because there's no such thing as a magic indicator. And if you are to use indicators, don't use too many. Let's say, for example, you use momentum indicators to confirm your price action. Example, CCI, example, RSI, for example, stochastics. And some people also regard MACD as a momentum indicator. Which one do you pick? Based on the pros and cons of all these indicators, you pick one. What I don't want you to do is to have 1, 2, 3, 4 right at the bottom. It's gonna be so confusing, my friend. So what a lot of beginner traders don't know is that technical analysis also prevent you from entering a trade. This is really important. Knowing when not to make a trade is just as important as knowing when to enter. But unfortunately, a lot of retail traders, they only learn about how to make entry points. So for example, if your fundamental analysis tells you that you should long euro dollar right now, but charts tell you that we are still in a bearish market, everything is trending downwards. Do you enter now? No, you wait for the price to reverse, for the bearish trend to end. Then you start to go in. For now, put it under your watch list. And also the good thing is that it is easy to analyze and use. But then the downside is that a lot of retail traders would think that they don't need to put in a lot of time to learn trading because it's easy to analyze. Some traders, they might use the same indicator, same setting, but they would use it wrongly, they analyze it wrongly. So it's not about what indicators you use, but it's about how you use it. Another good news is that can be applied to other markets. Some indicators and some strategies, you can use it the same way in other markets. Let's say, for example, in forex, you look at the same candlestick and you apply it in the stock market. It is the exact same principle, same meaning. Fundamental analysis in forex completely different from stock market, because stock market is you're looking at financial statements, balance sheet, cash flow statement, P&L. In forex, there's no P&L to look at. You need to look at central bank statements, inflation rate, money supply, historical money supply data, a lot of things you need to look at. And because you can analyze it so fast, you can do inter-market analysis really quickly. Because sometimes one market might give you a clue, a leading indicator, and it's going to tell you, okay, it is going to move this currency soon. So for example, if you compare oil with Canadian yen, very often times you realize that oil prices tend to move first before Canadian yen make its move, and this is where you need to study intermarket analysis. If you only use TA, you are going to lose money, which is a really sad story. It doesn't work around high impact events. That's why you cannot ignore the economic calendar completely. And also sometimes TA will not work when the markets, they are temporarily disrupted by people with deep pockets trying to move the markets. For example, high frequency trading, for example, algo trading from hedge funds. Especially those markets who are not that liquid is going to disrupt the market and hence going to disrupt your strategy. I'm sorry to break it to you. You can't use it to predict. But can the person who drove Lamborghini, you can achieve your dreams using indicators. Let that be your reality, okay? So what is Dow Theory all about? There are 6 main pointers. This one I already talked about, so we are not going to cover that. The second thing is volume has to confirm trend, and if you are a stock trader, you would know that volume is very important. So this theory says that when the market is on a bullish trend, when the market goes up in the direction of the bullish trend, the volume is going to increase. So during a bullish trend, there are retracement downwards before it goes up. So during the retracement, you would see the volume decrease. So when prices increase, volume is going to increase. When prices fall, volume is going to fall. This is what the theory says. But if there's a pullback, but the volume increases instead of decrease, it might tell you that a bear market is going to starts. So the next thing you need to know is the trend is going to continue until a reversal takes place. Now, no matter how strong the trend is, it is not going to last forever. So it's very important for you to learn how to spot false reversals and also real reversals. So the next point, markets have to confirm each other. So the creator of this theory is called Charles Dow, and of course he and a couple of friends, they refined it along the way. And they invented two indices, which is Dow Jones Industrial Index and also Dow Jones Transportation Average. So back then, they have this theory that says that if DJIA is doing well, then DJTA should be doing well too. But if DJIA is doing well, but DJTA is going nowhere, it is going down, it tells you that the trend is not going to be that strong. So if you're somebody who does intermarket analysis, make sure that you remember this theory. 3 types of trends: major trend, intermediate trend, minor trend. 3 phases of a trend: accumulation, distribution, and also trending market. So what's the difference between all of these trend phases? Okay, so if you're a trend trader, you need to know the different types of trends. The first type is what we call a major trend, and this will normally last from a few months to a few years. So if you're an investor, and if you're a trend follower, then this is the trend you want to get into. Another type of trend is called intermediate trend. Some people call this a reaction, secondary reaction. Basically, it's the same thing. You have a trend that lasts from a few weeks to a few months. So it's basically a retracement within a major trend. You have the minor trend, and this one lasts from a few days to a few weeks. And then for bull market, bear market, you have stages. So you have 3 main stages. The first one is accumulate, as ACCLATION. Accumulation stage. Then you have the trending stage, and then you have the distribution phase. So what does these 3 phases mean? So if you take a bull market, for example, let's say you have a ranging phase over here. Market's going sideways after a bearish move, alright? Then after that, it breaks above this ranging phase and it trends upwards. Along the way with retracements, at the end of the trend, it ranges again. Then it goes on to a bear market. So the first stage that you see over here is accumulation phase. Second stage, let's call it bull trending, okay? Bull trending phase. At the end of the bullish market, you have distribution phase. Over here, you have a bearish market, hence you have a bear trending market. And the process repeats itself again and again. Of course, in the real world, markets are not that straightforward. Sometimes the market would trend, it would do a V-shaped reversal instantly. It wouldn't range sideways, it wouldn't go sideways, it wouldn't give you any warning. It's just gonna free fall. Now, if you want to know more about this, it's in my free price action course. If you haven't checked it out, feel free to check it out. So if you are thinking about which chart should I use? Should I use the bar chart? Should I use line chart? Candlesticks? Each of these have their pros and cons. Line chart. The line that you see on your charts and also on CNN, CNBC, a lot of people use that, is based on the closing price. If you want a summary of what is going on in the market right now, is it in a bullish trend, bearish trend, you don't want to be distracted by market noise, then you look at line chart. Then how about bar chart? Some traders use it. I don't really use it, but basically anything that's on the left side, doesn't matter up or down, this is the opening price. Anything that's on the right side, the horizontal line is the closing price. So close right side, open left side. The good thing about bar charts is that you won't get distracted by the colors because all the colors are the same. Because with candlesticks, what a lot of people use is red and green, black and white, pink and purple. So what a lot of traders would do is that to reduce their trading emotions, they are actually going to change all their candlesticks to the same color. Everything, bullish candle, bearish candle, all same color. Doesn't matter what color you use. Black, white, whatever color you use. And also you need to look at the color for certain candlestick patterns, because for certain candlestick patterns, the color is important. For certain candlestick patterns, the color is not that important. In the forex markets, there are gaps. In stock market, there are gaps. If you come to Singapore, you take the train, there are gaps. In the markets, there are 4 types of gaps. The first one, in a ranging market, not so volatile market, there's a gap over here. In a consolidation sideways market, this is what we call common gap. Okay, it's very insignificant. So during a consolidation, there's going to be a breakout, right? So if there's a breakout and there's a gap upwards, there's a gap over here, this is what we call breakaway gap. It's a breakout from the range. So it doesn't have to break up from a range, it can break up from a chart pattern. If you have a chart pattern and it gaps upwards, it's also considered a breakaway gap. So once the breakup happens, a lot of times market is going to continue in the same direction. So if during the course of the trending markets, there's another gap over here, this is what we call continuation gap. Okay, as the name suggests, it occurs in the midpoint of a trending market. With anything, there's going to be an ending, and hence trends are going to end. Oftentimes, not all the times, but sometimes you see that before the market ends its bullish trend and go downwards, there's going to be another gap. And you can use this to signal you that the bullish trend might end, because this is called an exhaustion gap. So one thing about gaps is that gaps can turn into support resistance. So very often times you see that when there's a gap over here and the market retraces like this, the markets might bounce off from here before it continues to go down or continue to go up, because gaps can serve as a support or resistance. The downside with gaps is that if you are very lucky today, you put your stop loss over here, okay? Put your stop loss over here. Then Trump says something. Market plunges down, but oh wait, weekend comes. Market closes over here. Monday comes, opens right here. Guess what? Your stop loss is not going to get triggered, and hence you're going to lose more than what you have calculated. This happens more often in the stock market. Forex market, there are weekend gaps. Weekdays, on normal times, there's not a lot of gaps. So forex traders don't have to worry too much about this. There are many ways that you can classify indicators. Leading indicators, lagging indicators, visual-based indicators, math-based indicators, trend indicators, oscillators, support resistance, price action. Now I want to let you know that these are not mutually exclusive, because some trend indicators can be classified under oscillators. Some price action tools can be classified under support resistance. Trend indicators, example, moving average. Oscillators, some people further classify under momentum indicators, for example, RSI, MACD, CCI, stochastics. If we add one more classification I forgot just now, there's another thing called volatility indicators to measure the volatility of the currency. Of course, you can do statistical distribution to measure volatility. So example, ATR, you can use ATR. You can use Bollinger Band. You can also use it to measure volatility, because the wider the bands are, the higher the volatility. So very often times you find that when volatility decreases, the bands also become more narrow. Support resistance, you can look at horizontal lines. Trend lines can also act as support resistance. Your gaps also can act as support resistance. Fibonacci, some people use channels, some people also use fan lines. And again, because I said this is not mutually exclusive, and hence moving averages can also become support resistance, but to be specific, dynamic support resistance. And price action, the main ones, candlestick patterns and also chart patterns. So a lot of price action traders, they are going to use these tools along with price action. For example, trend lines with price action. They are also going to look at gaps. Some of them, they will add maybe one trend indicator. You can have a trading system with 40% win rate, just 40%, and you can still make money. It's not about what indicator you use, but it's about how you use it and how you apply your risk management into these indicators. So if you are a complete beginner, you come onto YouTube and all these people are talking about trading strategies, indicators, technical analysis. Which one do you pick? First thing first, look at the options that you have. Are you going to trade breakouts? Breakout from the range, from the consolidation, upwards or downwards? Or breakout from a chart pattern? In a bullish market, there are temporary retracements. Are you going to trade retracements? Market gaps. Are you going to, wait, I can't even spell today, man. Trend reversals. Are you going to pick tops and bottoms, just like our master Paul Tudor Jones? Or are you going to trade mini reversals? For example, you have a very strong support over here, and you anticipate that the next time the price bounces off one more time, I'm going to get in. Are you going to trade this reversal? Are you going to trade a lagging economic indicator like an FP? By the time you go in and scalp an FP, the professional traders are taking their profits. Or are you going to do it the professional traders way? You use fundamentals to determine where is the market going to go in the next few months, rather than where is the price going to go in the next few seconds. Which one do you think is less stressful? If you're a scalper, you would know. Now some people will call this trend following, and this is not easy because you know why? When you hold your trade for so long, first thing first, you need patience. And a lot of retail traders, what they lack is patience. Agree with me? Second thing is that your win rate is going to be very, very low. But then the good news is your risk to reward ratio is going to be very, very good. My question to you is, can you handle losses like a pro? Price action trading. Of course, there are a lot more strategies that I can cover until tonight, until midnight. But these are the few common ones that you can consider. If you're a complete beginner, you don't know where to start, price action, because it is easiest to learn. Learn this first, master this first, then you can consider other things like macro or picking tops and bottoms. So if you want a free price action course, completely free, I've done one in the past. I've also done a candlestick trading course. I'll put it somewhere right here. Okay, so with that, talk to you in the next video. Bye.